Hi, everyone. I'm Brian Manning. I'm a financial advisor here at Pinnacle Financial Partners in Nashville. And I'm thrilled to be back with you today to talk through some tax implications to individuals and small businesses from the CARES Act. I'm thankful that I get to be joined by business partner Paul Anglin. Paul is a CPA with Blankenship CPAs here in Nashville, Tennessee, and he's been kind enough over the years to give some of his time to help people understand some of the different changes in the tax laws and how they might impact individuals and businesses. And so Paul is kind enough to give his time today to spend a little bit of a time helping us walk through the CARES Act and how it impacts individuals and small businesses. So with that, Paul, I'll bring you in. Thanks for taking some time with us today. How are you?
Great, Brian. Thanks for having me on today. Appreciate the
Absolutely.
opportunity.
It's a very interesting, changing time right now, and we know in interacting with our clients that they are very interested in looking to us for lots of information and trying to disseminate all of the information that's swirling around out there. And so we're thankful for people like you to give your time to kind of walk through some of this. So I think in this first session, we'll be spending some time looking at how the CARES Act can impact small businesses, and specifically with relationship respect to taxes. So Paul, if you could just give us some general guidance, maybe let's start with employee retention credit for employers. Could you walk us through how the CARES Act is going to impact our small business clients from that aspect?
Sure, be glad to, Brian. Maybe before I hit that, it is interesting. The CARES Act was passed, probably about 6-8 weeks ago now. A huge document, 800 pages of information. Obviously, the big focus has been on the PPP loans that a lot of your clients and my clients have been, seeking and working through all those rules. But there have been a lot of overlooked provisions in the CARES Act that do relate to specific tax items. Some, unfortunately, don't apply if you did apply for a PPP loan and have forgiveness as well. Some of the provisions we're going to talk about in the next few minutes may or may not apply. But from a Blankenship perspective, we kind of looked at these as like these were the consolation prizes. So the PPP loan was definitely the way to go. It seems like the best benefit of the CARES Act for most of our clients and hopefully most small businesses. But if for the reasons that you couldn't acquire a loan, or maybe it didn't make sense to go for forgiveness, there were several other provisions in here that hopefully will help out small businesses and help weather the storm through this pandemic that we are facing. So one of those, as you just mentioned, Brian, is the employee retention credit. And this is probably the most significant piece of the CARES Act that hopefully would help our clients if they were not eligible for the PPP loan. So let me stress again that is one of the requirements. To get the employer retention credit, you could not receive the PPP loan. And again, just I know from my own client experience, I would say probably over 90% have taken advantage of the PPP. So, for those of you that were not able to get that, this is out here. So this is a pretty nice little credit. It's up to $10,000. It's up to $5,000 of a credit. It's based on $10,000 of wages per employee. So, a nice little benefit, $5,000. I guess that adds up in your employee base. So just kind of simple terms, it does depend if you're over 100 employees or less than 100 employees. Very good news for those that are under 100 employees. Basically, all of your workforce would be eligible for this credit. So if you had 10 employees, that's potentially $5,000 times 10, a $50,000 credit that you would take against your employer side of your payroll tax credits. And you would basically just shortchange your payments. And then when you file your employment reports, you would take that off as a deduction. So it gets cash in the hands of businesses quickly. And the mechanics is just working through your employment filings on your 941.
And so, Paul, as I sort of thumb through some of your notes that you had made, one of the things that stuck out to me is also businesses that experienced a 50% reduction in their quarterly receipts also potentially could be impacted by this. Could you talk about that a little bit?
Right. Two definite provisions there. So 50% based on the same quarter from the prior year versus the comparative quarter of this year. If you have a reduction of 50% in receipts, you would be eligible for the credit. That credit eligibility would terminate once receipts, I believe, are 80% of the same period from the prior year. So it is a definitive period of when you could actually claim the credit, but to the extent that those factors stay in place, the 50% reduction, this would go from, I believe, from March all the way through the end of the year is the time frame those wages would qualify. I guess I should point out too, even though you look at this and claim the credit on a quarterly basis, it is an annual cap. So the $5,000 credit is a per employee per year cap. You can't claim the same $5,000 four times on your quarterly. So it is limited from that nature. Also, if you were subjected to a government mandate to shut down, those were some other provisions to say that you would be eligible for the credit. Of course, if you're shut down, it seems like you would easily meet the 50% reduction. But I guess there are circumstances where maybe reduced clientele coming into your establishment, maybe you have some reduction due to a mandate, or it's also interesting. Anything in a government, there's definite definitions of what a mandated closure is. As the IRS pointed out, a tweet from a government official is not necessarily definitive that there is a mandate that you shut down. It has to be, something more substantial. So a lot of interesting guidance around that.
Yeah, Paul, so that's all very helpful. Can you talk for a little bit about maybe delaying the payment of the employer portion of payroll taxes and what people should be looking for and understand about that?
Sure. Another good provision in the CARES Act is potentially the deferral of payroll taxes. And this is on the employer portion of the payroll taxes. Again, this is one of those provisions that anyone can take advantage of. But if you have forgiveness of your PPP loan, the deferral ends at that point in time. So technically, companies right now could defer those payments. But as the PPP forgiveness period, those calculations will most likely start, 1st of July. So as the forgiveness starts to come clear for our, companies, small businesses, at that point in time, the deferral ends. If you didn't get the PPP loan, obviously this is probably something you would really want to look at, because there's not going to be a forgiveness if there's not a PPP loan. I think the caution here is, be careful that there are substantial penalties for not paying into the trust fund of the employer payroll taxes. So what we're afraid of is that a company thinks, hey, I'm going to take this deferral. They're out of cash, has no money to make the payments when the deferral ends, and then you can be in serious trouble at that point. So definitely this needs to be a priority in your cash flow management if you are going to take advantage of the deferral. But quite frankly, we've been advising our clients, if you've applied for the PPP loan and you're going for forgiveness, probably best recommendation is to not go for the deferral. Saying all that, if you did do the deferral, it is a nice little deferral. So the employer portion of payroll taxes can be deferred all through 2020, and then they're payable in two payments, 50% each, in December of 2021 and 2022. So definitely a good short-term loan. Just make sure that you have the cash to make those payments at that point in time.
So if I'm understanding that correctly, Paul, they've got the opportunity to defer those payroll taxes and I guess make those payments, half of it in the following year in 2021, and then the remaining half in 2022. Is that correct?
That's correct, Brian. So a very nice, like I say, that's a nice government interest-free loan. There's no interest on that, no penalties on that. So you just make the two 50% payments at the appropriate time, and you would be good.
Yeah, I think that's helpful. So I guess as we move through this, looking at businesses with a net operating loss, what sort of modifications were included in the CARES Act that could impact those businesses?
Yeah, great question. It's interesting. Thinking, Brian, I think the last time we had a presentation was when the Tax Cut and Jobs Act passed, which was not too long ago at the end of 2017. And one of the provisions in the TCJA was a lot of limitations around net operating losses. In fact, that act prohibited any carryback of losses and also established an 80% utilization of losses on a go-forward basis. So we fast forward to 2 years in the COVID pandemic, and Congress looked at that and said, hey, this is a great opportunity for companies to get cash back in their pockets if we allow NOL carrybacks. So those provisions were loosened in the CARES Act. So any NOLs arising in 2018, 19, or 20 can be carried back 5 years, and the 80% limitation was not put in place. So 100% of your loss from any of those 3 years can be carried back a full 5 years. There's still some questions out there regarding what if you had AMT, alternative minimum tax. There's several provisions out there that are still a little bit unclear just how the mechanics of that work, but generally this is a nice little benefit if you did sustain a loss and can carry that back to free up some money and get that in your pocket quickly.
Yeah, I think this is a great time to kind of jump in, and it feels like we do this disclaimer quite a bit, but if you haven't caught on already, there's a lot of information to go through here. And so we would absolutely recommend that you sit down with your CPA as you're walking through this year and trying to make sure that you're documenting everything properly and that you know and you have the information so that you're well suited to do that. It's a lot for any individual to try to keep up with on their own. And so be sure you're leaning on the professionals, your CPAs, to go to and look into that. Paul, as we walk through some more of this, what are some of the other provisions for businesses that are found inside the CARES Act?
Sure. Several other provisions. There was going back to the TCJA, there was a limitation placed on losses that could potentially limit a loss to $250,000 or $500,000 for married filing joint couples. To be honest, in practice, I'm not sure I've seen that limitation put in place, but if you did have a business entity that was facing that limitation, that has been postponed, at least temporarily, through the Act. Again, just for the lack of probably that being in play, I think we can move forward to some of the other provisions. The corporate minimum tax, so we talked about the alternative minimum tax. If there was any credit that had not yet been claimed, this is typically seen on a C corporation return, but if there's anything out there that has not been claimed, 100% of the remaining amount could be claimed in 2019. So as you're doing your returns now for 2019, make sure you claim those. One of the other provisions of the Tax Cut and Jobs Act, as a way, the Tax Cut and Jobs Act was lower the rates but broaden the base. And one of the ways they broadened the base was having some interest expense limitations. So kind of just in loose, big terms, there was a limitation of 30% of your adjusted earnings was your limitation on the amount of interest you could claim on your tax return. Because of the obviously losses and everything that are being generated at this time, if business is being closed, this makes perfect sense that they looked at this in the CARES Act and said, we're going to loosen those restrictions. So for 2019, the 30% cap went to 50%. And there's some other favorable adjustments there too that you can look to your, in 2020, you can look back to 19 and pick the better of the 2 years to make that calculation. So loosening there of those limits was great. But probably the biggest one out of the CARES Act, we've been waiting for this for 2 years, ever since the TCJA was passed, was the Qualified Improvement Property Technical Correction. We kept thinking as soon as the TCJA was passed that everyone was screaming about qualified improvement property and not being bonus eligible. This was corrected in the CARES Act. So maybe back up, what is qualified improvement property? Prior to the TCJA, this was like restaurant or retail improvement property. So basically improvements made to commercial buildings outside of the time of the initial purchase of the building. So a few years down the road, a restaurant does a remodel, for instance, that would have been considered QIP. And under the old laws, that would have been bonus eligible as it was deemed to be 15-year property. When they wrote the law under the TCJA, trying to simplify 3 areas into one, they forgot to mention that this was bonus eligible. So finally, we have that opportunity to know that this is bonus eligible and gives us an opportunity for anything placed in service post December 31 of 2017. Taxpayers have the opportunity to go back to 2018, and then for 2018 you can amend and then obviously correct that for your 2019 to get that as bonus eligible property. So some great provisions there, just getting hopefully money back into taxpayers' hands during this hard time.
Yeah, Paul, I think that's all really helpful. I think to your point earlier, a lot of the focus was on the PPP loans, and initially that's what everybody was interested in. But I think it's been really helpful to kind of have you highlight some of the key factors that can still impact small businesses. In most cases, it was for people that didn't receive the PPP loan, but in some cases, maybe it can apply for both. Any other final thoughts that you would share to small businesses as they're doing some tax planning and trying to understand the impact of the CARES Act to them?
Sure. Even though we're trying to separate this out as the tax provisions kind of outside the PP, you really have to think of these together. Just as we mentioned about the qualified improvement property, that's great to get bonus depreciation, which is 100% write-off. But if you're self-employed, for instance, and filing a Schedule C and you're taking big write-offs, that's going to limit the amount of income you have, which could potentially reduce the amount of forgiveness you have on your PPP loan. So you have to look at all this together. As we've been saying in our firm, it's not just looking at PPP forgiveness, but maximizing your liquidity and looking at what your needs are. So, if you're going for maximum PPP forgiveness, some of these ideas might not be applicable right now, but might come in handy next year as these provisions will stay in place. But as you said a moment ago, Brian, the best thing, consult with a CPA or your advisor to make sure you're thinking through these provisions correctly. A lot of complicated issues there, especially with the NOL, and hopefully more guidance is coming that will help us get through these, but definitely seek a professional that can help you through those.
Yeah, that's great advice, Paul. And that's our goal with taking a few minutes and putting these webinars together, is to take all the information that's swirling out there and consolidate it down into something that's helpful to our clients, our small business owners and individuals. And we would encourage you to check out our YouTube channel. We're continuing to put out information and content as more information comes out to us, and we get great people like Paul that come along and join us. So be sure to check that out. Also check out our Small Business Resource Center at pnfp.com. And Blankenship CPAs has some phenomenal information as well. We would encourage you to check out their website at bcpas.com. So that's Blankenship CPA Group here in Nashville, Tennessee. Paul, you've been a great help to us today. Thanks for taking a little bit of your time to help talk about how the CARES Act impacts small businesses. And we look forward to talking with you again soon.
Thank you very much, Brian.